The idea of an Iran shock isn't just another headline designed to scare investors. It represents a potential chain reaction that can ripple across the global economy in ways most people underestimate. Whenever tensions rise in the Middle East, oil markets react first, and oil is not just another commodity. It is the backbone of modern economic activity. When oil prices surge, transportation costs increase, manufacturing becomes more expensive, supply chains tighten, and ultimately consumers feel the pressure through higher prices on everyday goods. This creates a cascading effect that moves from energy markets into every corner of the economy, and that is where the real impact begins to take shape. As oil prices rise sharply, inflation begins to accelerate, but at the same time economic growth starts to slow down. Businesses struggle with rising input costs, consumers cut back on spending, and hiring slows. This combination of high inflation and weak growth is what economists refer to as stagflation, and it is one of the most difficult environments for policymakers to manage. The Federal Reserve, which typically responds to economic slowdowns by lowering interest rates, finds itself trapped because inflation is still elevated. Cutting rates too quickly risks making inflation worse, while raising rates further could deepen the economic slowdown. This creates a policy gridlock where no option feels safe, and that uncertainty is exactly what markets hate the most. When uncertainty rises, markets do not wait for clarity, they react immediately, often violently. Stocks begin to fall, not necessarily because the underlying businesses are failing, but because fear spreads faster than facts. Investors start selling to protect their capital, institutions rebalance their portfolios, and liquidity begins to dry up. In these moments, correlations go to 1, meaning everything starts dropping together regardless of quality. Strong companies, weak companies, growing companies, it doesn't matter. Prices fall across the board because the dominant force is not logic, but emotion. This is where most investors make their biggest mistake. They interpret falling prices as a signal that something is fundamentally broken, when in reality, it is often a signal that fear has taken control of the market. They sell at the worst possible time, locking in losses and missing the eventual recovery. What they fail to understand is that markets are forward-looking mechanisms. By the time the news feels the worst, markets have often already priced in a significant portion of the downside, and when conditions begin to stabilize even slightly, markets can recover far faster than people expect. For those who understand this dynamic, periods of chaos are not something to fear, they are something to prepare for. Because while the majority of participants are reacting emotionally, a small group of disciplined investors is quietly positioning themselves to take advantage of mispriced assets. They recognize that great companies do not suddenly lose their long-term potential because of a temporary macro shock. Revenue-generating businesses with strong margins, durable competitive advantages, and exposure to long-term growth trends remain valuable, even if their stock prices temporarily decline. If you look back at history, this pattern repeats itself over and over again. During the financial crisis of 2008, markets collapsed under the weight of systemic risk and uncertainty. In 2020, during the global pandemic, markets experienced one of the fastest crashes in history. In both cases, fear dominated the narrative, and many investors believed that recovery would take years. Yet in both cases, the strongest companies not only recovered, but went on to reach new highs. The reason is simple: innovation did not stop, demand did not disappear, and the long-term trajectory of technological progress remained intact. This is the mindset shift that separates average investors from those who build real wealth over time. The goal is not to predict exactly when a crisis will occur or how severe it will be. Trying to time the market with precision is extremely difficult and often counterproductive. Instead, the focus should be on preparation, building a strategy that allows you to act rationally when others are acting emotionally, because when fear peaks, prices often disconnect from intrinsic value, and that gap is where opportunity is created. One of the most common traps investors fall into during macro shocks is chasing the most obvious trade, When oil prices rise, they rush into energy stocks. When gold starts moving, they pile into precious metals. While these trades can work in the short term, they are inherently cyclical and often crowded. By the time the average investor enters, much of the upside has already been captured, and the risk of reversal increases. When the cycle eventually turns, those same investors are left exposed, often selling at a loss. A more effective approach is to focus on assets that compound over time, rather than react to short-term events. These are businesses that are aligned with structural growth trends that continue to expand, regardless of temporary disruptions. Artificial intelligence, cloud computing, digital infrastructure, cybersecurity, and automation are all examples of such trends. These are not dependent on a single macro event. They are driven by long-term shifts in how the world operates. Even in the face of geopolitical tension, the demand for computing power does not disappear. Data centers still require energy. Companies still invest in software to improve efficiency, and organizations still need protection against cyber threats. In fact, in many cases, uncertainty accelerates the adoption of these technologies as businesses look for ways to become more resilient and cost-effective. This is why focusing on long-term winners can be far more rewarding than chasing short-term volatility. Another mistake that feels safe but can be damaging over time is moving entirely into cash. On the surface, holding cash during uncertain times seems like a logical decision. It provides a sense of security and protects against immediate market declines. However, in an environment where inflation is elevated, cash steadily loses purchasing power. What appears safe in the short term can become a silent risk in the long term, as the real value of that cash erodes over time. The key is not to avoid risk entirely, but to manage it intelligently. This means maintaining exposure to high-quality assets while also keeping enough liquidity to take advantage of opportunities as they arise. It is about balance, participating in long-term growth while being prepared for short-term volatility. This approach allows investors to remain engaged with the market without becoming overly vulnerable to sudden shocks. Understanding market psychology is also critical during these periods. Fear and greed are powerful forces that drive short-term price movements, often more than fundamentals. When markets are rising, optimism can push valuations to unsustainable levels. When markets are falling, pessimism can drive prices below what is justified by the underlying business performance. Recognizing these emotional extremes can help investors make more rational decisions, avoiding the common pitfalls of buying high and selling low. Ultimately, the concept of the Iran shock or any major geopolitical event is not about predicting disaster. It is about recognizing how such events interact with existing economic conditions to create volatility, and within that volatility lies opportunity for those who are prepared. The difference between those who build wealth and those who lose it often comes down to mindset and discipline. Those who react emotionally tend to follow the crowd, while those who remain focused on fundamentals are able to take advantage of the crowd's mistakes. The market does not reward panic, it rewards patience. It does not favor those who chase headlines, but those who understand long-term trends. And while no one can control external events, every investor has control over how they respond to them. By focusing on quality, maintaining a long-term perspective, and preparing in advance for periods of uncertainty, it becomes possible to turn moments of chaos into opportunities for growth. In the end, the real question is not whether a shock will happen, but whether you will be ready when it does. The first principle of this framework is accepting that you will never catch the exact bottom. This is one of the biggest misconceptions in investing. People wait for the perfect moment, the point where prices cannot possibly go any lower, but that moment is only visible in hindsight. In real time, it feels uncertain, uncomfortable, and risky. Prices can always go lower than you expect, and if you wait for complete certainty, you will almost always miss the opportunity. This is why disciplined investors rely on dollar cost averaging a strategy that removes the pressure of timing and replaces it with consistency. By investing a fixed amount at regular intervals, you naturally buy more shares when prices are low and fewer when prices are high, smoothing out your average cost over time. This approach becomes especially powerful during periods of market stress. When prices are falling, your instinct might be to stop investing and wait, but that is precisely when dollar cost averaging does its best work. It forces you to lean into weakness rather than run from it. Over time, this creates a position that benefits disproportionately from the eventual recovery. It is not about being aggressive. It is about being consistent when others are inconsistent. The second principle is maintaining a strong core allocation to broad market exposure. While individual stocks can generate significant returns, they also come with higher risk. Even great companies can underperform for extended periods due to factors outside their control. By keeping a portion of your portfolio in a broad index, you ensure that you are participating in the overall growth of the economy. This acts as a stabilizing force, reducing the impact of any single mistake and providing a foundation upon which more targeted investments can be built. The third principle is avoiding leverage at all costs during uncertain times. Borrowing money to invest can amplify gains, but it also amplifies losses. In volatile environments, this can be devastating. If markets move against you, margin calls can force you to sell at the worst possible time, turning temporary declines into permanent losses. Many investors underestimate this risk because leverage feels manageable during stable periods, but when volatility spikes, the rules change, and what once seemed like a smart strategy can quickly become a liability. Staying unleveraged gives you the flexibility to hold through downturns and take advantage of opportunities instead of being forced out of your positions. The fourth principle is focusing on fundamentals rather than noise. In the short term, markets are driven by headlines, sentiment, and speculation. News cycles amplify fear and exaggerate uncertainty, making it difficult to separate signal from noise. But over the long term, stock prices are driven by business performance, revenue growth, operating margins, and net income ultimately determine value. Companies that consistently grow their earnings and improve efficiency tend to see their stock prices reflect that progress over time, regardless of temporary volatility. This is why it is important to understand what you own. Instead of reacting to every piece of news, focus on whether the underlying business is improving or deteriorating. Is the company gaining market share? Is it expanding its margins? Is it investing in future growth? These are the questions that matter. When you have confidence in the fundamentals, it becomes easier to stay disciplined during periods of market stress. Another key aspect of execution is building a shopping list before the chaos begins. Waiting until markets are already falling to decide what to buy puts you at a disadvantage. Emotions will be high, information will be overwhelming, and decision-making will become more difficult. By identifying high-quality companies in advance, you create a clear plan of action. When prices decline, you are not guessing, you are executing. This shopping list should focus on companies that are positioned to benefit from long-term structural trends, businesses involved in artificial intelligence, semiconductor production, cloud infrastructure, cybersecurity, and automation are all examples of areas with strong tailwinds. These industries are not dependent on short-term economic conditions. They are driven by ongoing technological transformation. Companies operating in these spaces often have durable competitive advantages, high switching costs, and significant growth potential. It is also important to think in terms of systems rather than individual decisions. A system reduces the influence of emotion and increases consistency. For example, you might decide that every time the market drops by a certain percentage, you will deploy a portion of your cash, or you might commit to investing on a fixed schedule regardless of market conditions. The specific rules are less important than the discipline to follow them. Over time, a well-designed system can outperform sporadic decision-making simply because it eliminates hesitation and second-guessing. Patience is another critical factor that is often underestimated. Building wealth through investing is not a quick process. It requires time for compounding to work, and that means enduring periods of volatility along the way. Many investors become frustrated when results are not immediate, leading them to abandon their strategy prematurely. But the reality is that the biggest gains often come after the most uncomfortable periods. Markets tend to recover when sentiment is still negative, and those who wait for clear signs of improvement often miss the early stages of the rebound. It is also worth recognizing that not every investment will work out. Even with careful research and a disciplined approach, there will be mistakes. This is a natural part of the process. The goal is not to be right all the time, but to ensure that your winners outweigh your losers over time. This is achieved through diversification, position sizing, and a focus on quality. By spreading your investments across multiple high-conviction ideas, you reduce the impact of any single failure while maintaining exposure to potential upside. Another layer to consider is the psychological aspect of holding investments during downturns. Watching the value of your portfolio decline can be uncomfortable. Even if you understand the long-term thesis, this is where conviction becomes important. Conviction is built through research and understanding. When you know why you own something, you are less likely to be shaken by short-term price movements. Without that understanding, it becomes much harder to stay the course. As markets begin to recover, a new challenge emerges: knowing when to hold versus when to take profits. The temptation to sell after a strong rebound can be strong, especially if you have experienced significant volatility. However, selling too early can limit your upside. Many of the most successful investments continue to compound for years, far beyond the initial recovery phase. This is why it is important to differentiate between short-term trades and long-term investments. For long-term positions, the focus should remain on the underlying business performance rather than short-term price fluctuations. Over time, this approach creates a powerful effect. By consistently investing in high-quality assets, maintaining discipline during downturns, and allowing compounding to work, you begin to build momentum. Small gains accumulate, reinvest, and grow into larger gains. This is how wealth is built, not through a single perfect trade, but through a series of well-executed decisions over an extended period. The concept of generational wealth is often misunderstood as something that requires extraordinary luck or insider knowledge. In reality, it is more about consistency and perspective. It involves thinking beyond short-term gains and focusing on long-term growth. It requires the ability to stay calm when others are panicking and to remain patient when progress feels slow. These qualities are not easy to develop, but they are what separates successful investors from the rest. As you move forward, the most important thing is to take action, not reckless action driven by emotion, but deliberate action guided by a clear plan. Start building your system, define your rules, and identify the types of assets you want to own. You do not need to have everything figured out immediately. What matters is that you begin the process and refine it over time. Because when the next wave of volatility arrives, and you won't be reacting like everyone else, you will be prepared. And in a market driven by fear and uncertainty, preparation is one of the most valuable advantages you can have.